Hello and welcome to the Patient Swing Traders YouTube channel. In our previous tutorial videos, we've covered the basics of investing and trading, differentiating between the two, and providing definitions for different types of securities such as stocks, ETFs, mutual funds, and bonds. We've also demonstrated how to set up a trading platform using Power E-Trade and various indicators such as the Heikin-Ashi candles, CCI, MADC, Money Flow Index, Moving Averages, RSI, Stochastics, Volume, and VWAP. In this video, we will take a deeper dive into each indicator's application on our trading platform's chart and how to use them for research and market analysis. We will also introduce key terms such as support and resistance, which are essential in identifying possible entry and exit points following bullish and bearish consolidations in connection with Fibonacci retracements. These exercises will be helpful in allowing you to play around with your platform using paper trading. It's important to note that while indicators provide guidance, a patient swing trader and long-term investor should not rely solely on them. Instead, it's essential to also consider market trends and conditions before making any trades. Overall, this video series aims to provide you with the necessary knowledge and skills to set up a trading platform for the long haul. So, be prepared for some homework as we start to get technical. In order for us to have a better understanding of our platform setup, here is a brief explanation of each of the indicators we discussed earlier and how they can be used in research and market analysis. Heikin-Ashi candles. The Heikin-Ashi candles are a type of Japanese candlestick chart that are used to identify trends and momentum in the market. These candles are calculated based on the average price of the previous candle and can help traders identify potential trend reversals. Moving averages, represented by the blue line, is MA21, the yellow lines is MA50, and the white line is MA200 on the chart, are types of technical indicators that are used to identify trends and momentum in the market. Moving averages can be calculated using different time periods and can help traders identify potential support and resistance levels. VWAP, represented by the white line, the volume weighted average price, or VWAP, is a technical indicator that measures the average price of a stock over a given period of time, weighted by its trading volume. The VWAP is used to identify potential support and resistance levels and can help traders identify potential entry and exit points. Volume. Volume is a measure of how much a stock has been traded over a given period of time. High volume can indicate the strength of a trend or a potential trend reversal. MADC, the Moving Average Deviation Convergence (MADC) indicator, is a momentum oscillator that is used to identify changes in trend direction. It is calculated by taking the difference between two moving averages and plotting them as a histogram. Stochastics. The stochastics oscillator is a momentum indicator that measures the relationship between a stock's closing price and its trading range over a given period of time. Stochastics is used to identify overbought and oversold conditions in the market and can help traders identify potential trend reversals. CCI. The Commodity Channel Index, or CCI, is a technical indicator that measures the difference between the current price and its historical average. The CCI is used to identify overbought and oversold conditions in the market and can help traders identify potential trend changes. RSI, the Relative Strength Index, or RSI, is a momentum oscillator that measures the strength of a stock's price movement over a given period of time. The RSI is used to identify potential trend changes or confirm existing trends, but it may also give false signals in choppy or sideways markets. Money Flow Index. The Money Flow Index, or MFI, is a technical indicator that uses both price and volume data to measure buying and selling pressure in the market. The MFI is used to identify overbought and oversold conditions in the market and can help traders identify potential trend reversals. Each of these indicators has its own strengths and weaknesses, and traders may choose to use one or more of them depending on their individual trading style and goals. It's important to remember that technical indicators are not foolproof and should be used in conjunction with other forms of analysis, such as fundamental analysis and market news, to make informed trading decisions. Fibonacci. The Fibonacci retracement is a popular technical analysis tool that traders use to identify potential levels of support and resistance for a security's price movement. It is based on the mathematical sequence discovered by the Italian mathematician Leonardo Fibonacci, in which each number is the sum of the two preceding ones. Here is a view of the sequence: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, etc. In trading, the Fibonacci retracement levels are derived from the recent high and low points of a price movement, typically over a period of time. To use Fibonacci retracement, a trader needs to identify a recent or the latest significant high and low point on a chart, and then draw lines at the key Fibonacci levels of 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels represent the potential pullback points where the price may find support or resistance as it retraces its previous movement. Traders use the Fibonacci retracement levels to identify potential entry and exit points for a trade, as well as to set stop loss and take profit orders. For example, if a security is in an uptrend and has retraced to the 38.2% level, a trader may see this as a potential buying opportunity if they believe the uptrend will resume. On the other hand, if the security is in a downtrend and has retraced to the 61.8% level, a trader may see this as a potential selling opportunity if they believe the downtrend will continue. In addition to the standard Fibonacci retracement levels, traders may also use extensions or expansions to identify potential price targets. These levels are drawn beyond the 100% level and are used to project the potential length of a trend or correction. Fibonacci retracement levels can also be used in conjunction with support and resistance levels to identify potential reversals. For example, if a security is in an uptrend and has retraced to the 50% level, which coincides with a previous resistance level, a trader may see this as a potential reversal point if the price fails to break through that level. Similarly, if a security is in a downtrend and has retraced to the 38.2% level, which coincides with a previous support level, a trader may see this as a potential reversal point if the price bounces off that level. If you are using the Power E-Trade platform, here is a quick view on how to draw the Fib retracements following a recent bullish move. Support and resistance. The support and resistance levels are two important concepts in technical analysis that traders use to analyze stock price movements. Support level is a price level where the stock has historically had difficulty falling below, meaning the demand for the stock is strong enough to prevent it from falling further. In other words, it's a price level where buyers are willing to buy the stock, which creates a floor or support level for the stock price. If the stock price does break below the support level, it can be a sign that the trend may be reversing or that the stock may continue to decline. Resistance level is a price level where the stock has historically had difficulty moving above, meaning the supply for the stock is strong enough to prevent it from going higher. In other words, it's a price level where sellers are willing to sell the stock, which creates a ceiling or resistance level for the stock price. If the stock price does break above the resistance level, it can be a sign that the trend may be reversing or that the stock may continue to rise. The support and resistance levels can be used to identify potential entry and exit points for trades. When the stock price approaches a support level, it may be a good opportunity to buy the stock because there is a high chance that the price will rebound from the support level. Conversely, when the stock price approaches a resistance level, it may be a good opportunity to sell the stock because there is a high chance that the price will reverse from the resistance level. In addition to horizontal support and resistance levels, traders also look for trendline support and resistance levels. Trend lines are diagonal lines that connect the price highs or lows on a chart. A rising trend line connects the price lows, while a falling trend line connects the price highs. Trend lines can also be used to identify potential entry and exit points for trades, as well as to confirm trend direction. When the stock price approaches a rising trend line, it may be a good opportunity to buy the stock because there is a high chance that the price will bounce off the trend line and continue to rise. Conversely, when the stock price approaches a falling trend line, it may be a good opportunity to sell the stock because there is a high chance that the price will reverse from the trend line and continue to fall. We hope you found this video session informative and helpful in understanding the basics of different indicators. If you enjoyed this video, please consider giving us a thumbs up and subscribing to our channel for future video tutorials. By subscribing and hitting the notification bell, you'll be notified of our upcoming videos, including the next session where we'll be discussing how to identify crossovers, engulfing candles, and confirmation candles as part of your market analysis and research on your trading platform. Thank you for watching, and we look forward to seeing you in the next session.